Ladies and gentlemen, good evening. This is Christopher Aaron. It is the 22nd of February, 2017. In this update, we will look at gold and silver briefly, but I want to focus on the mining sector in this update specifically. And especially, I want to show some examples as to why you should never hold the leveraged funds, specifically the NUGT and the JNUG, as a long-term investment. I see this happening a lot. I see a number of people doing this. They are trying to leverage the gains that are happening in the miners as well as in the metals themselves. And there is a specific reason why you should not do this. This could be really hazardous toward your entire financial position if you're heavily invested in the precious metals. And if you are right on the move that I anticipate is just in the beginning stages of unfolding, that eventually could lead to some sort of a real mania in this sector if the dollar falls as far as I anticipate it may over the next 5 to 7 years. You want to make sure that you are structured properly. And the way to do this is not by holding these funds for the long term. So we're going to look at that in more detail this week. Thank you for being with me. As a point of order, I wanted to say that I will be having an interview with another technical analyst next week. I'm excited about that. We're going to discuss the gold market primarily and just get another opinion, another educated assessment from the standpoint of someone who approaches this from a technical basis. As you know, I do understand the fundamentals. I think it's important to understand the fundamentals of the metals, but we have plainly seen that you cannot rely on the fundamentals alone. Otherwise, the metals would have kept going up in 2011, 2012, 2013. And if you just rely on the fundamentals, you are asking to be clobbered when the market has a significant correction, which it does periodically. So that interview will be this time next week. It should be a good one. Looking quickly at gold and silver here, gold has been steady, very steady, grinding action that we've seen here in gold above the most recent resistance level that was exceeded a few weeks ago around 1220 and below the resistance around 1245. Looking at silver, it's looked really nice here, just consolidating underneath the $18 level for the most part. There is a specific technical reason why I believe silver is doing that. I can't get into that in this video. I do have higher targets for the metals over the next couple of weeks that I'm expecting some very distinct targets. Let's move along. Let's look at the gold and silver mining complex. I know a lot of people are invested in this. I am myself personally. Let's just look at what's happening here in the sector. Let's take a look at the GDX fund. Now, the GDX, for anyone who's new, is a fund that holds approximately 50 of the largest gold and silver mining companies in the world. And these companies, their profits are leveraged to the prices of the metals themselves. So you have to be very careful if you're investing in the sector, because if the metals rise by $100 or $200 or $300 per ounce, for example, in the price of gold, it is quite possible that, as we've seen here, the mining companies can rise 100 or 200%. At the same time, if the price of the metal such as gold falls by $100 or $200, it is quite possible that the mining companies can fall by 50 or 60%, as we have seen. So, do you put all your money into the gold and silver mining sectors if you believe the metals are going higher? You could, but that requires a very high risk tolerance, and I would never want to tell anyone to do that. I like to accumulate the metal myself on a regular basis. It really provides a peace of mind for a long-term investment. That said, here's what I see shaping up in the gold and silver mining sector. It looks to me like what's happening here is you have a very clear resistance level here underneath 25.26 on the GDX, and you've had these this first sweeping move down from early October below 25 down to around 22.5 and then back up to 25. You had another sweeping level come in here back from 25 all the way down to 19 and come right back up to that same level. So this 25.26 level here on the GDX is forming a very important resistance level, and it looks to me like what is happening here is we're having this back off right now, this mild retracement here, it looks to me like what is setting up is a head and shoulders bottoming pattern of this most recent correction. So what will we look for here if this is going to remain valid? We should see a fairly light volume pullback come in here onto the GDX. And then we should see when this begins to round out, which may take another few days, up to perhaps 2 to 3 weeks, you should see a surge when the GDX breaks through this neckline here. You should see a surge, perhaps at least twice the daily normal volume, and that should set the stage for a target of at least 31, which would bring the GDX back to the August high. So this would be a fairly significant move if this sets up. Now, just as a caveat, no pattern that I work with, no pattern that any technical analyst works with, I say this quite often, is 100%. In my experience, the head and shoulders patterns have about a 60 to 70% success rate, which means about 30 to 40% of them fail in one form or another. So you have to build that knowledge. If you're an investor or trader, you like to focus on the technicals, you have to build the knowledge that you have to watch out for what goes wrong. Just like you buy insurance for your car or for your health, not hoping that something goes wrong, but what if something goes wrong? In exactly the same way, when you're focusing on the technicals, you build in a knowledge, what if something goes wrong? So let's keep this in mind. Now, if this pattern works out like I'm expecting that it is here, based on a lot of the signals that we're seeing across the entire complex, inverse signals that I'm seeing in the US dollar, the leadership that I'm looking at here provided by the mining sector, and if this target gets hit back up here around 31, I want to put this into better perspective. What is really happening here from a big picture standpoint? Okay, here is where this head and shoulders pattern, this inverse head and shoulders pattern, should be playing out. It should take us back up to this black double line, which corresponds with a horizontal support and resistance line on the key. So if we came back up to this level, look how important this level is. This level was hit in 2016 right here. This level was hit in 2013 once or twice, and this level basically has served as this long-term resistance level. Now, when you have a long-term resistance and you have a lot of swooping type of action underneath a long-term resistance level, what starts to become more apparent is that you're looking at a massive multi-year bottoming process, okay, that features a lot of these sort of false starts and really dramatic moves and then retracements. But this entire thing is actually taking the shape in and of itself of a much larger inverse head and shoulders pattern underneath this 30 to 32 resistance level here. So the pattern that we're seeing play out right now over the short run is just one of those shoulders forming here on the larger pattern. Now, the left side of this larger pattern, you can see, had at least one, if not two, distinct swooping shoulders. So if this pattern is going to form evenly, then we should see something like the 30 to 32 resistance hold again on this most recent attempt that I believe is coming up. And we should see something like another swooping, scary kind of correction in the later part of this year. So there may be the need or the desire to purchase some insurance here if you're holding a leveraged portfolio in the equities when that comes up later this year. That said, I will say this once again, in a strong market, which all signs are pointing that this is a major generational turnaround that is happening here in the sector. In a strong market, the sector will basically start to move before a very even formation of a head and shoulders pattern. You'll have maybe a very small second right shoulder form sometime in the middle or later part of this year, and really not give people an ideal opportunity to come into the sector. So I do believe that if you are looking to make some leveraged investments in gold and silver through the mining sector, the time to be doing that is upon us. I don't know how much more of a swooping type of correction we will have later on in this year. although it is, of course, possible to see a 10 or 20% correction in any given week in this sector. So let's keep all those points in mind here. Now, back to what I wanted to get into at the very beginning of this video, why you should never hold the NUGT or the JNUG leveraged ETFs for the long run. Okay. Now, for those who are not familiar with the NUGT or the JNUG, these funds are designed to provide 3 times the daily leverage of the underlying index. In this case, they're not exactly the same index, but the NUGT basically is designed to provide 3 times the performance of the GDX. And you can see this is a 2-month example. We're looking from the lows most recently in December of 2016 through the present. You can see as the GDX is up 27% here, the NUGT is up an impressive 94%. So it's tempting to say, well, if this is the case, and we believe that the miners are going to be moving higher over the next 6 to 12 months, and especially over the next 3 to 5 years, which is really the bigger picture perspective here, why not establish a core position in the leveraged funds, just average your way into it, and hold that thing for the next 5 years? And I'm going to show you why. Okay, and there is a mathematical reason for this, but I don't want to get bogged down with that. I want to show you in visual form, which is more powerful, why this should not be your strategy. Let's look at a 2-year example now. And once again, we have the GDX in red and the NUGT in blue. Now, this is from the beginning of 2015. Okay, so from the beginning of 2015 in the GDX, you've had a lot of gyrations. You had a little rise, a fall into the middle part of 2015, the big rise we saw last year, and this fall again, leaving you with basically a 30% gain in the GDX in the last 2 years. Compare this to the NUGT. The NUGT, remember, is designed to give you 3 times this gain on a daily basis. Now, people who misinterpret that to think that it's supposed to give them 3 times this gain on a long-term basis are sitting here saying, why isn't the NUGT at plus 90% over the last 2 years? GDX is plus 30. Why isn't the NUGT plus 90? And the reason is the mathematical decay effect that is an inherent part of this fund. And it's why you must not own this fund for the long run under any circumstances. Let's look at an even more dramatic example. Since the 2011 highs, this is absolutely brutal. The GDX is still down 61% from its previous highs in 2011. The NUGT down 99%. And here's the key point. Both the NUGT and the JNUG will not recover. Ever. It is impossible for them to recover this loss due to the mathematical decay effect that is an inherent part of the structuring of these funds. It's not due to management fees. It's not just due to slippage. It's due to the way these funds are structured. Okay, so GDX at this point, if the GDX were to recover its 2011 highs, which I do believe it will be doing within the next couple of years, you would be looking at something like 150% rise from here. The NUGT will not be recovering its 2011 highs. So the leveraged funds, they feature a mathematical decay that can never be recovered. Please keep this in mind. I could do the mathematical example here. I just don't want to bore people. I don't want to lose people's interest with this. Suffice it to say, these funds are designed to provide a 3 times leverage to the daily movement of the underlying, and that daily results in a decay effect over anything longer than a multi-month period. 1 to 60-day moves are all that can be realistically captured by these leveraged funds. So if you're a trader, these funds can be useful. If you want to make a 1-day trade or a 1-week trade or maybe even a couple weeks up to a couple months, these funds can be useful. But really, in my experience, 60 days or so, about 2 months of trading is all that can be realistically captured. After that point, that decay effect really starts to bite into any sort of outperformance that you're seeing. In a range-bound market, this is even more important. In a range-bound market, basically a market that is moving sideways over the long run, the NUGT and the JNUG will lose value even as the GDX maintains its value. So not only do you have to be right on the direction with these things, you have to be right on the timing. If you buy the GDX and it happens to take 6 months longer to move than you expect it will, you will pay by owning these, whereas the GDX, all things considered, should be roughly even. So if you want long-term leverage to the prices of the metals, what is the proper strategy? It is to pick strong individual mining equities. This is what I do for myself. I will occasionally trade the leveraged funds. I will never own the leveraged funds for the long run for myself or for anyone who I advise for this reason. Individual miners. You want to find individual miners that are engaged in building a new mine. Restarting an old mine can be a very powerful turnaround situation. Expanding their production. If they're growing from 100,000 to 150,000 ounces, for example, over the course of a couple years, lowering their cash costs is a big one. And finally, if they can find a new discovery, a new deposit, this is one of the most powerful things that a company can do if you are owning it as the price of the underlying metal is rising. So in summary, guys, if you're looking for long-term leverage, please look at the individual miners. Do your research on that. Do not own the NUGT and the JNUG for more than a couple of months at the absolute maximum. Thank you once again for watching. I appreciate everyone tuning in, and I will try to answer, if there are any questions about this, I will try to answer those in the box below. The premium research that does come out for subscribers every week covers not only the GDX and the individual miners that I myself own, but the physical gold and silver markets, buy and sell signals, currencies, etc. If you have a particular situation that you would like an independent perspective on, I do not sell these funds. I have no financial ties to anything in this industry other than trying to help people achieve the best returns they can as the sector does what I think and what a lot of people here think it is going to do. So if you would like an individual perspective, please get in touch. You can find that on the website. Thanks again. Have a lovely evening, and I will see you this time next week.